The first modern inversions, 1950s to 1970s. In the decades after World War II, inversions were rare. When they did show up, they often arrived early, long before most people believed trouble was coming. One of the first major examples appeared in 1957. Short-term rates moved above long-term rates as monetary policy tightened. At the time, the economy still looked healthy. Growth had been strong, and confidence remained high. Yet within months, the United States entered the 1957 to 1958 recession. The inversion did not cause the downturn, but it signaled that pressure was already building. A similar pattern appeared again in 1969. Inflation was rising, and policymakers responded by tightening financial conditions. The yield curve inverted as borrowing costs increased. Once again, the economy did not collapse immediately. But by 1970, growth slowed, unemployment rose, and a recession followed. The most dramatic inversion of this era came in the early 1970s. In 1973, the curve inverted as inflation pressures collided with rising energy costs. The oil shock that followed intensified the strain already in the system. The result was the 1973 to 1975 recession, one of the sharpest downturns of the post-war period. Across these early examples, a clear pattern emerges. Inversions often appeared during periods of tightening, when central banks were trying to slow inflation without damaging growth. On the surface, the economy still looked strong. That appearance of stability made the signal easy to ignore. This created a psychological trap. Because the damage did not arrive immediately, people assumed the warning had failed. In reality, the inversion had simply arrived early. But these early inversions, while serious, were not the most destructive ones. High inflation era inversions, late 1970s, early 1980s. By the late 1970s, the economic backdrop had changed completely. Inflation was no longer a mild concern. It was embedded in everyday life. Prices were rising quickly, confidence in the currency was weakening, and policymakers faced far fewer easy choices. This is when yield curve inversions began to reflect not just caution, but real policy-driven stress. The first major inversion of this era appeared between 1978 and 1980. Central banks raised interest rates aggressively in an effort to regain control over inflation. Short-term borrowing costs surged. Credit became harder to access. The yield curve inverted as the economy struggled to absorb the shock. Growth slowed sharply, and the country entered a recession in 1980. But the pressure did not end there. A second, deeper inversion followed between 1980 and 1982. Rates were pushed even higher as policymakers doubled down on tightening. This time, the impact was severe. Businesses faced soaring financing costs. Consumers pulled back. Unemployment climbed rapidly. The recession that followed was one of the harshest of the post-war period. These inversions were different from earlier ones in an important way. The damage was not caused by uncertainty alone. It was driven by deliberate policy choices. Inflation had reached a point where tightening was unavoidable, even if it meant economic pain. The yield curve reflected that reality. Credit conditions tightened across the economy. Loans became more expensive. Refinancing became difficult. Weaker companies failed. Stronger ones survived, but only by cutting back. What makes this period important is not how fast the economy broke, but how clearly the outcome was locked in. Once the curve inverted under such extreme policy pressure, reversal was unlikely. The system needed to reset. The key distinction is timing. The damage did not happen overnight. Markets did not collapse immediately. But once these inversions appeared, the path forward narrowed. The recession was delayed, not avoided. And that leads to a deeper question. If we have seen many inversions across history, which ones caused the most lasting damage? Well, as the economy moved into the late 1980s and 1990s, The financial system became more complex. Credit markets expanded, financial products multiplied, and global capital flows increased. Yield curve inversions still appeared, but their effects became harder to read in real time. And that's when the 1989 to 1990 inversion arrived. The modern financial system inversions, 1989 to 2000. During a period of tightening financial conditions, inflation pressures were building and interest rates had risen. Credit stress began to show, particularly in commercial real estate and banking. At the time, the broader economy did not look fragile. Yet soon after, growth slowed and a recession followed in the early 1990s. Once again, the inversion appeared before the damage was obvious. A decade later, the pattern repeated in a different form. In 2000, the yield curve inverted as the technology boom reached its peak. Confidence was extremely high. The internet was transforming business, and many believed traditional economic limits no longer applied. Despite the inversion, markets continued to rise for a time. Optimism drowned out caution. When the dot-com bubble finally burst, the adjustment was sharp. Stock prices collapsed, investment dried up, and the economy slowed. The inversion had not predicted the exact moment of the crash, but it had reflected the imbalance building beneath the surface. What these episodes reveal is how confidence can delay recognition of risk. Markets do not always react immediately to tightening conditions. Prices can keep rising, even as pressure increases in the background. That delay makes the signal easier to dismiss and harder to act on. And this is a crucial point. Markets often rise after inversion, and that delay is part of the risk. It creates the illusion that the warning has failed, when in reality it is still working. The inversion that appeared in 2006 marked a clear turning point. The 2006 to 2007 inversion. A turning point. The financial system had become deeply dependent on credit. Housing prices were rising rapidly, lending standards were loose, and leverage was spreading through banks, households, and investors. The yield curve inverted and stayed that way. This was not a brief signal or a technical anomaly. It was prolonged, and it deepened over time. Short-term borrowing costs rose while long-term rates remained low, showing that the bond market was growing uneasy about the near future. Despite this, the warnings were largely ignored. Home prices continued to climb. Markets remained calm. Risk-taking increased. Many believed the economy was strong enough to absorb higher rates without serious consequences. What made this inversion different was its structure. It was deep, meaning the gap between short-term and long-term rates was large. It was long-lasting, meaning the pressure did not fade. And it appeared in a system already loaded with leverage. When the system finally broke, it happened quickly. Housing prices fell. Mortgage defaults surged. Banks faced losses they could not contain. The recession that followed was not mild. It became a global financial crisis. This inversion mattered because it reflected more than policy tightening or temporary fear. It revealed structural weakness. The economy was not just slowing, it was unstable. If this breakdown is helping you see the pattern more clearly, hit like. It really helps. And if that was not enough, another inversion arrived. The 2019 inversion. A confusing signal. The inversion that appeared in 2019 confused a lot of people. It was brief and the economy did not immediately slow in a dramatic way. Markets reacted, then recovered. Growth continued. That led many to label it a false signal. At the time, the debate was intense. Some argued the yield curve had lost its meaning. Others pointed to low inflation and global demand for bonds as reasons the inversion should be ignored. Because nothing broke right away, confidence returned quickly. Then 2020 arrived. The recession that followed was not caused by the yield curve itself. It was triggered by the pandemic. But the inversion had not vanished. It had already reflected fragility in the system. When the shock hit, the economy had little buffer. This is an important lesson. Inversions do not disappear just because something else takes over the story. They show underlying conditions. If another event arrives, it can accelerate what the signal was already suggesting. This is why treating inversions as precise forecasts leads to confusion. They are not crystal balls, they are stress indicators. And that brings us to the most misunderstood inversion of all. The 2022 to present inversion. The inversion that began in 2022 stands apart from the others in a critical way. It has been deep, long-lasting, and broad. Multiple yield curves inverted at the same time, and they stayed that way far longer than most previous episodes. This was not a brief warning. It was persistent. At the same time, the surface of the economy looked calm. Employment remained strong. Markets recovered after initial declines. Spending continued. That contrast made the signal easy to dismiss, just as it has been in the past. But beneath the surface, conditions were tightening. Credit became harder to access. Borrowing costs stayed elevated. Banks grew more cautious. Businesses and households began adjusting to a higher cost of money, often quietly and gradually. What makes this inversion especially important is when it appeared. In past cycles, inversions often came before major intervention. This one came after it. Interest rates had already been held near zero for years. Balance sheets had already expanded dramatically. Debt levels across households, corporations, and governments were already high. That means the system entered this inversion with fewer tools left to respond. Policy flexibility was limited. Cutting rates or adding stimulus carries more risk than it did in earlier cycles. The margin for error is smaller. This is why the timeline matters. The inversion is not just reflecting fear. It is reflecting constraint. The economy is adjusting under conditions where reversing course is harder and slower. Not all yield curve inversions cause the same level of damage, and the reason is not mysterious. It comes down to structure. 3 factors matter more than anything else: how long the inversion lasts, how deep it becomes, and the economic backdrop in which it appears. Duration matters because time allows pressure to spread. A brief inversion can reflect temporary uncertainty or a short-term policy shift. A long-lasting inversion suggests that stress is not resolving. Depth shows the intensity of concern. A shallow inversion signals caution. A deep inversion signals fear. When short-term rates rise far above long-term rates, it reflects a strong preference for safety over flexibility. Historically, deeper inversions have been associated with more severe downturns. The economic backdrop matters because the same signal behaves differently in different environments. An inversion during low debt and flexible policy conditions can be absorbed more easily. An inversion during high debt and limited policy room is far more dangerous. When all of these factors line up, the inversion becomes more than a warning. It becomes a reflection of fragility already built into the system. That is why some inversions pass quietly, while others reshape the entire economic landscape. But what do you think about today's yield curve warning? Let us know in the comments below. And if you want to see how an economic reset could unfold, check out our next video.